Good evening. This is Ken Long from Tortoise Capital with a daily debriefing from the Tortoise chat room of January 29th, 2014. We're going to take a look at my favorite daily template for trading and see how we can apply it with the Frog trading system for a candidate that was an excellent swing trade target, Cliff's Natural Resources, and then see how we can leverage the insights from swing trading and combine that with daily trading. So in this daily template, what I'm showing is 1 day's trading activity between the blue lines. So this blue line here shows the close of day -1 and then the open of the 0 day or today. And that goes all the way to the close indicated by that blue line. So we have the close of yesterday and then the open of today, and the difference between them we define as the gap. The gap stat is a statistical measure where we take a look at the average gap of the last 30 days, and then we take the standard deviations of those gaps, and then that tells us the difference between a small gap and a large gap. So the gap stat is the standard deviation of the last 30 days of gap. The next measure we look at is based off the open, low, high, close structure. And so we have the open here, we have the low of the day here, we have the high of the day here, and then the close of the day here. And this is my favorite daily template because I like to see the gap down. I like to see a quick sell-off to the low of the day, then a move to the high of the day, and then a price decay into the close. That's my favorite pattern to trade. So if the gap stat is the standard deviation of the last 30 days from the close to the open, and that accounts for opens that are higher than the close. We're interested in the absolute value and taking the standard deviation of that. The fail stat is what we call the average move from the open to the low of the day for the last 30 days. My hypothesis is that, especially on gaps down, that the open is where market makers are prepared to buy if they have to. If there's no one else to offload the inventory to, and they have to buy it there, then that's a price that they'll open it at that they're willing to start buying. On a bullish kind of a market, where we expect the bias to be upward, I then think of the open to the low as the distance that they have to move it while they're finishing up the overnight orders. So what I'd like to see is an early move to the low of the day, find support, and then start to reverse. Well, what we do is measure from the open to the low of the day of the last 30 days, take that average and call that the fail stat. So if we see a gap down and a sell off, and it moves one fail stat and starts finding support and then starts to move up, whether that's the market or an individual target, then we have reason to believe that that might be the low of the day, and then we can start acting with the frog standard deviation to start buying the retracement. We then take a look at the moves from the low of the day to the high of the day. That's the range. So we take the last 30 days of the range, find the average, and then add one standard deviation of that range to it, and we call that the range stat. So that's average plus one standard deviation of the last 30 days. We consider that to be the maximum reasonable intraday move. That anything beyond that, price has moved into irrational exuberance. Statistically speaking, of the last 30 days, 85% or 5 out of 6 of the ranges have been at the range stat or less. So by definition, any day that moves beyond a range stat is 1 out of 6, or what we would consider to be an abnormal move or irrational exuberance. So the range stat from the low of the day to us represents the maximum reasonable upper day limit for intraday trading. And if we see hesitation around there, then we have reasons to preserve that profit because we got everything that we could reasonably plan for. Now, if price moves beyond the range stat and we're willing to stick around, we should never let price come back below the range stat because we will have we will start to be given back some of our professional profits. Now, the distance from the open to the close, we call that the difference between those. We look at that as the follow through. So in this case, we could see opened here, closed here. That would be a positive follow through. If it opened here and closed down here, that would be a negative follow through. So now we have the open, the low, the high, and the close. The fade stat we haven't used as much because we don't like trading the last 30 minutes, but that measure would be the average distance between the high of the day and the close, and that'll give us some sense of how much this sells off going into the close. So when you build that composite candle, we start thinking of signal to noise ratio. We think of the distance between the open and the close, or if this was a red candle, from the open to the close, as the signal, because that's the directional move of the day intraday. And then the wicks of the candle would be noise. So when we take the absolute value of the open minus close and divide it by the high minus low, that gives us a signal to noise ratio, which is a number between 0 and 1. And that, when we look back at the last 30 days, we then could build a sense of just how trending intraday that particular target is. Now, our target for the day, Cliff, has a high signal to noise ratio, so it tends to have a lot of candles with mostly real body. That makes it a good intraday trading target. So just another way to look at that with the definitions, I'll leave that for you there. Open to low of the day is the fail stat, the average from the open to the low of the last 30 days. Gain stat is from the open to the high of the day. That's the average of the last 30 days. The average range from high of the day to the low of the day. Frog standard deviation is that average range plus a standard deviation in either direction. So if we saw something that looked like the low of the day and we wanted to see the maximum reasonable intraday move, we would measure from the low of the day a range stat up, then that would give us the upper target if price were climbing. If price were failing, we would start from the high of the day, measure down an average plus a frog standard deviation, and that would give us the maximum reasonable intraday move to the downside. These are the stats and definitions of the fail stat and the gain stat. You can pause the tape and look at that if you want to, but I've already described what that looks like. Essentially what we're looking at is if it closed here, opened here, sold off, a fail stat, started finding support, we would look at that as a reasonable place to start looking for a retracement trade intraday. Same thing on the gain stat. Opened here, was bought all the way up to the high of the day. If that was a gain stat and then started to fail, we would consider that a place to start getting short or preserve profits if we had made our purchases in here. So we're going to take a look at a case study in market on January 29th with the market looking like this. Generally bullish. These are daily charts about 4 months. Pardon me. The 30-day trend is flat because now the market, the last 30 days is rolled over. And then the last 10 days has featured about a 5% sell-off coming down to the bottom of the floodplain, which is 2 Bollinger Bands of 30 period, plus or minus, and that's right at the -2, right at the edge of support, and so the market's in a critical state. 2 days ago, big red candle down. 1 day ago, sell off. 3 days ago, big red candle, more selling. One retracement, and then today a doji that ended up right on the lower support level. So the market is in a critical state. The entire bull market is now in jeopardy with price at the key price support level of 177. If it fails here, it's going to hit 74.72 and then down to the 200-day moving average. So that's the market context. Now we're going to take a look at Cliff's Natural Resources. This is a daily chart over about the last 2.5 months. It's been in a downtrend. One slight retracement, rolled over, regression line crossover, failed down outside the river to the edge of the actually to outside the floodplain, and then yesterday had a 6% gap up, sold off the rest of the day, but still closed with an upward trend. The first real buying impulse that we've seen in Cliffs, and that was echoed in the XLI industrials. So people buying value on sale. And so today we're going to look at the follow through day that ended up looking like this candle. And we're going to see that we made some money on the long side inside that little candle using the frog. Now, if we zoom in on Cliff, now we're looking at 2 hours and 10 days. That's that long last sell off. Yesterday was this large gap up and then decayed into the low of the day. Yesterday was a good frog day to be short Cliff. We've got some case studies on that too. And then today, gap down, small gap down, and then finish the day higher. So we're going to take a look at what the frog values look like. Now, when we consult the frog, we find that Cliffs Natural Resources, symbol CLF, the frog standard deviation is 40 cents. This yellow bar represents 40 cents. Half a frog, 20 cents. And so here is the open at this blue line. This was yesterday's close. This was today's open. This was a small gap. It was only about 20 cents. So we're not expecting a big follow through today. It sells off pretty quickly. It's about a 20-cent sell off from the open to the low of the day, and then reverses. When it reverses off the low of the day, it didn't even fail a fail stat. We took a position here on the accelerated leapfrog at 1950. The full frog move off the low of the day, one standard deviation north, would buy right around 9:40, so about 20 minutes into the session. This is a 1 minute time charter or timeline. The leapfrog entry would have been here with a full standard deviation stop, and then as this moves up, this stop starts moving up. The market was so vulnerable today that as I manage this thing in practice, rather than just let the trailing stop would have looked like this, but the rest of the market was really weak, and so I was playing this one closer to the vest because we wanted to cash. My actual trade was this accelerated leapfrog, and its stop. I'm managing its stop, and just as this is about ready to make a frog entry, I'm already in the money, so I'm not going to lose any money on this one. And then that joins the trailing stop of the conventional frog. And then at this point, with price at about 20.05, we're at 1990, so we're about 1 hour in hand already at this point. So rather than let this sell off a full frog standard deviation like the mechanical rules, I like to manage my stops and get and lock in profits in this critical state. This is the same chart now, a little bit deeper into the trade. So our actual entry was here on the accelerated leapfrog. This would have been the leapfrog standard entry, one's SD off the low. This one was a half SD off the low. So I didn't add a second position because I didn't have 2R in hand with momentum. So as I'm managing my trade here on this red line, when we get this intraday peak, we're about almost an R in hand. It pulls back, finds support, and starts to resume. This feels good, and I've got a nice profit in hand. At 2, I add a second position at 20.06. That's about, so we're 50 cents to the good, so we're about 1.2 R. I like the way it's moving. I make my entry. Shortly thereafter, about 10 minutes later, I'm at no lose on the second entry. Makes a high, pulls back, makes a lower high, starts rolling over. That's enough for me. I don't want this position to go negative. So for money management psychology reasons, I take my exit at 3. Now, as we're getting the second position in, we're already estimating now the range stat because we were able to get 2 bullets into this trade. So we measure off the low of the day, or like 1933, plus the range stat is $1.31 in Cliff's Natural Resources, which we see right here. Cliff range stat is the average plus a standard deviation is $1.31. So 1933 plus a buck 30 gets us up around 2062. So it's only at 2025 right here. So there's another 40 cents, 35 cents available to the north. But still, that's a pretty nice move intraday. That's getting most of the range stat. And so that's a good place to lock it in. And so entries at 1956 and 2006 with a 40-cent stop. That's the yellow bar. Gives us, with an exit at 2012, gives us 1.3 R. This box here shows that first trade. It finds support after we exited. So we're just watching this. And then by inspection, we see it makes a double top, comes back, makes a higher low, a second higher low. And my sense is that if it breaks through this double top, it's going to go. I decide to front run that. And I'm going to take a entry at 2020. I'm only going to use a zero point 0.2 stop. Now I'm using the half a frog. It makes a nice move. Fine. By the time this price is here, I'm at no lose. We get a second entry when this is taken out at 2043, also with a 0.2 stop. And now what we're tracking is the range stat from the low of the day plus a buck 31 would take us up to about 2062-ish. And so what we get is a range stat move and hesitation, and that's enough to get me out. It continues right after that, but now we're right at the boundary of irrational exuberance, and I don't feel like I can. I don't want to. I want to have a position with money in hand. I don't want to start a position right at the edge of the range stack because that's very vulnerable to pullback. And even if I had gotten back in here, this adverse move would have gotten me out for a scratch. But I don't like entering positions at the range stat. I want to have money in hand and then be surprised if it explodes through. So from the first two ventures this morning, we're at 1.3R and 3R, so we're a little over 4R on Cliff. When we take a look at the full day on Cliff, these are those two trades in perspective. This is that range stat. Um, it it found some support here, but never really was able to get outside of that. There were other things going on in the afternoon. I had stopped trading right around in here. I was doing some writing, but we got a 1, 2, 3, 4, a quadruple top here. If you were inclined to play the trade into the close, you wouldn't be wrong to let it move a full standard deviation off and get short here with that as your stop. If you wanted to play the half frog or an accelerated frog, your entry would be from the high, come down. Your entry to get short would be about here, and with a full frog SD, you would have enjoyed that trade into the afternoon and have to exit back around 20. You probably get another half an hour, maybe an hour. Now, XIV was our other trade that morning. All the same statistics related to XIV, excuse me. Here's the half a frog, there's the full frog. Big gap down. It was a 4 standard deviation adverse gap. That tells us there's a probability of an exceptionally large range, so that's when we definitely want to get early. So from the low, I take the accelerated leapfrog at a half an SD off the low of the day with a full SD stop. This is where the conventional frog would have to wait to enter. As it turns out, there was no follow through on XIV for most of the day. Sold off sharply in the afternoon. That was a good trade in the VIX going north. So that's what our entry looked like. with our SD stop. It never really threatened. Into the lunch hour, it made this minor move, a lower high, came back. We decided just to go ahead and scratch out of that. It didn't look promising. If we had played the mechanical rules, um, with this as the high of the day, a full SD stop off the high of the day would have been here. So if we had stayed with the mechanical entry on the accelerated frog, then this would have been a minor loss of about looks like about 20 cents on 70, so been about minus zero point 0.2 or zero point 0.3. But XIV turned out to be a scratch. So managing our target list, Cliff and XIV were both on our list. Cliff because it was an excellent intraday candidate. XIV because it's one of our standard volatility pairs, so we're always interested in that one. And that's what the trading day with the frog looked like today. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.